Just a quick disclaimer that right line trading takes no responsibility for any participation or visitors or subscribers when the futures or forex markets, nor for any profits or losses. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account. We are not registered financial advisors and not licensed commodity trading advisors, commodity trading advisors. So with that disclaimer, what I'd like to do is just get a little bit about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson College. I published close to 15 peer-reviewed articles in first-tier journals, and I've been involved in the financial markets for over 20 years. Now, right-line trading is the product of over a decade of analysis of price action, market structure, and indicator algorithms. And our software is based on mathematical modeling. And what we believe is that each financial market is simply a closed system. And every closed system in mathematics can be described by a series of independent variables. And essentially in the markets, those independent variables are forces which create changes in price. If you take those independent variables and you put them in a multivariable equation and optimize it, then you can, with great precision, determine the future movement or future direction of price on any trading instrument. And the one thing about our software and our indicators is they work on any time frame in any market. They work on futures and they work on Forex. And this morning we were trading stocks and we were trading futures. We had 3 trades. We had 3 winners. And this week we've only had 1 losing trade in the live trading room. And to call those trades in advance, they're all taken live. So what I'm going to do, it's not the next hour, but the next 45 minutes, and I'm talking a little fast because I want to get all the information in and show you how to find low risk, high reward trading entries. And isn't really that what it's all about? You need something that shows you clearly when you can get a low risk, high reward entry. You've got to know exactly which direction you have to trade in order to keep from getting stopped out, and you have to get a precise entry. And that's exactly what I'm going to show you. It's not a black box system. And I'm going to show you every independent variable that you're going to need in order to take a real good trade. I use this every day in the live trading room. Now, respecting volume-generated areas of support and resistance is critical and fundamental component to successful trading. Now, a volume has really become a very, very sophisticated analysis because volume has been turned into order flow tracking. It's been turned into market delta. It's been turned into into volume profile. Now we put that all together in a way that's really going to allow you to really provide yourself with really, really low risk entries. Now this is really not secrets, and I don't know why I call them that, but these are things that you have to know. The first is that support and resistance zones are dynamic, and they are constantly changing, and they're recalculating intra-candle. So whatever software you're using, it's got to adjust intra-candle, and 99% of all indicators or systems that do this do not. They wait to make their adjustment until candle close. If you're trading a 3-minute or a 9-minute, or you're trading a 4-hour or an 8-hour bar because you want to swing trade, you want to stay in your positions for 2 or 3 days, you cannot wait till candle close. You have to see where all these areas are as you're looking at the trade and watching it evolve. And there's no formal zone of support or resistance. When resistance breaks, it becomes support. When support breaks, it becomes resistance. Now, these zones and all of this analysis is really going to tell you when to pull the trigger. And you're going to make money, because I do almost every day in the live trading room. Now, if you haven't seen it before, this is volume profile. And what this tells you is how much volume has accumulated at any given price on any trading instrument over the look back period for this volume. It could be a 2-hour, a 4-hour, a daily, a weekly, or a monthly. It doesn't matter. For some fixed period of time, this tells you how much volume has accumulated at any given price. And if you have any questions, you can ask them, because I have the question box open. Now, here's just another example of volume profile. And again, all it's showing you is volume at price, how much volume is accumulated at each tick level, pip level, or cent level if you're trading stocks. Now, in a perfect world, all of this data would be normally distributed and would create this bell-shaped curve. But this isn't the perfect world, but this is what the math is based on. And this shows you what a sound foundation you're working with. And one standard deviation's worth of volume at price creates a fair value for your trading instrument. And the mean price, or the point of control, which is the price that accumulates the most volume, and that's the price that traders like to trade the instrument the most. If you swing around it, that's one standard deviation's worth of volume, and that creates that fair value area. Now here's just another representation. This is normally distributed data creating essentially a bell-shaped curve, even though it's a triangle. Here's the value area high, value area low, and point of control. Let's see why these areas are really so critical. Now, if volume is normally distributed, the point of control would be along this blue line. Instead, it's along this black line, and here's the POC. Now, here's 66 2/3% of all volume at price. It's bounded by the value area high and the value area low. And there's the point of control. Now, the point of control, which in this case is crude, is $53.49. This attracts price. This is the area, this is the price that most traders have wanted to trade crude in the look back period for this volume. And this is about, on our system, it does a look back period. I can't tell you exactly how far it looks back, but it's over 2 days. So this is going to attract price. When price gets to the value area high, it's going to be pushed down. When price gets to the value area low, it's going to be pushed up. So these are some of the forces that are brought to bear on the future movement of price on a trading instrument. It's going to want to stay inside the VAH, VAL, and get attracted to the point of control. And really, I just wrote it out. VAH, prices repelled down, value area low, prices pushed up, and the POC strongly attracts price. If you're talking about regression to the mean, this in essence is the mean price or the most commonly traded price of the day. Now, in addition, as I had mentioned, market profile is dynamic, and this is constantly changing. If you're trading futures, it's every tick. If you're trading stocks, it's every cent. If you're trading Forex, it's every pip. Now, what's also important are low volume nodes. Now, these are areas of price rejection. They're the exact opposite of the point of control. And these are areas where traders do not want to trade this instrument. These are prices that have been rejected, and there's almost no volume. So at 23.46 on the E-mini in this particular period, no one wanted to trade that price. And at 23.25 on the E-mini, nobody wanted to trade that price. So now you have two reasons or two different forces As price moves up into this area, it's going to get pushed down by this low volume node because this is a price rejection. And it's going to get pushed down by the value area high because it wants to stay within fair market value. And the exact opposite is true for the low volume node and the value area low. So what it creates are zones of rejection. And these are confluent low volume nodes with the value area low, confluent low volume node with the value area high. And price is going to have a real tough time moving through these areas. Now, I've seen it very commonly described that these are formal areas of rejection, formal areas of support or resistance, and they are not. It all depends on where price is located. If price is located below, it's an area of resistance. When it breaks, it becomes an area of support. So I've seen these on many different software packages create red zones for resistance, blue zones for support, and there's no formal support or resistance zone. It's simply a zone that price does not want to cross, and when support is broken, it becomes resistance, and when resistance is broken, it becomes support. And this is what traders have told you. These are the areas that they don't want to trade. And so it's not some sophisticated esoteric analysis. Traders have said this is a price they don't want to trade, and they want to keep any financial instrument within fair market value. Now, this is an analysis that some indicators do. This is the delta of every candle. And it tells you whether there's an overabundance of buyers or sellers, or an overabundance of traders at the bid or ask, which is the same thing, on each candle. And it creates a delta. And this delta analysis here is simply just telling you what's going on in this particular number. And then you get the bid-ask disparity within each tick value. And if you, or cent value or pip value, and if you try to use this, it's going to drive you crazy. And it doesn't have any predictive power, just as this doesn't have any predictive power. It doesn't tell you where price is going to go. All it does is make you focus in on numbers that provide you with no decent information. So what we've done is we've taken them out. And what we have created is called a commitment of traders. And the COT is the point of control of every candle. It's a very sophisticated analysis, and it's very predictive of the direction of price. And if you use it, it's going to really help you get low risk, high reward entries. Now, if you look here, when you're looking to take a long trade, if the COT or commitment of traders is at the lower 1/3, right at the bottom of the candle body, this means buyers have staked out a major area here. There's an overabundance of buyers, and they push up, and they're pushing right off of the support of the value area low here. And you get a great long trade off a dual support. Now, the COT or commitment of traders also gives you a real good handle on whether an area of support or resistance is going to break as you approach it. This is the VWAP, or volume weighted average price, which is part of the analysis. And as you move into it, if that commitment of traders stays low in the candle, and is surrounded by this intense light green, it tells you that buying is very strong in this candle, and that resistance here is likely to break. And it does. And then when you come back to support here, the COT is right at the bottom of the candle body, telling you that you're very likely going to get a continuation long trade into the trend. It really helps with the precision of your trading. And you want to use all these parameters to get yourself better entries. Now, this helps you on counter trend trades. You come up to resistance. If the COT, right here, it's not. It's more towards the middle of the candle. And even though it worked, this is a higher risk counter trend trade. Here, the COT is all the way at the top. On a long trade, you want the COT to be at the bottom of the candle. On a short trade, you want the COT to be at the top. So you get a great reversal. These are 13-tick candles. This is about a 20-tick trade. Here, it's at the top off the point of control, and you get a massive trade. This is about a 60-tick trade reversal. Just by assessing the position of the commitment of traders at an area of dual resistance. Another long trade, and this is a counter trend reversal trade. Here, the COT is all the way at the top. It does move up, but it doesn't move up in a low risk way. Here, the COT is at the bottom of the candle. And it tells you that buyers have come in strongly. They've created this base, and you can see that you get a great counter trend trade. And again, this is another enormous trade. It's a 60 or 70 tick trade. Again, on the E-mini, the commitment of traders at the bottom, on a long, up. Here's the COT at the top, short. Whoops. Okay, now, for this webinar, we also add an additional analysis. And that additional analysis is momentum and order flow. So the analysis, the system does order flow tracking, and it does this order flow tracking automatically. Now, the upper line assesses momentum, and there's a lot of ways to assess momentum. You can use an oscillator, you can use a MACD, but what we do is we use Heikin-Ashi momentum. And this is assessing momentum. If you're trading a 3-minute, it's looking at the momentum direction on your 9-minute and your 27-minute. If you're trading a 5 range, it's looking at your 8 and your 13. If you're trading a 377 tick, it's looking at momentum on your 610 tick and the next higher fib number. So it doesn't look at momentum on your trading chart. It looks at momentum on the 2 higher time frames. Order flow is telling you who's in control of the market, buyers or sellers. Remember, I showed you that there's a delta of every candle. We put the delta number of each candle in a moving average and create a delta moving average. Nobody else does that. And when the delta moving average of the 2 higher time frames is down, then there's a clear cut overabundance of sellers. When it's up, there's an overabundance of buyers. Now, you don't want to trade in the opposite direction to this analysis. If you do, the probability of getting stopped out is exceedingly high. Now, here's the delta of each candle. Now, when I shot this slide, it was after market, so there was no delta calculated yet. But we look at the 2 higher time frames, take this delta, this number, put it in a moving average, and on the 5 range, it will be done on an 8 range and a 13 range. Now you can see when order flow is telling you that there's an overabundance of sellers on your trading dome, your price on your trading chart is almost always going to fall, and you can only take a short trade. When order flow is telling you that there's an overabundance of buyers on the 2 higher time frames, price is almost always going to rise. So this is giving you an absolute direction to trade. If you try to counter trend trade this direction, you can see all the traders in these pink candles. they're all going to get run over. And what these traders are doing is they're trading oscillator divergence, MACD divergence. Maybe they're trading fibs, which I think is a hoax. The future, the movement of price on a market is not determined by an 11th century mathematician's analysis. It's really determined, it's basically determined on who's in control of the market, buyers or sellers. It's based on money flow. These are the things that move price. Now here's an example. When momentum and order flow align and you trade in that direction, the likelihood of a winner is exceedingly high. You wait until this area of resistance is broken, and as soon as it does, since order flow and momentum are aligned to the upside, all you can take is a long trade. Cannot take a short trade. If you try, like all the traders do in these orange candles in a counter trend direction, there's a very high probability that you're going to get stopped out. Same thing. Now I took off the time frame and I took off the instrument because it's irrelevant. When order flow and momentum align, the only trading direction you can take is long. This is not looking at price on your trading chart. That's what makes it different from other indicators. Other indicators look at your trading charts. When price goes up, they turn green. When price falls, they turn red. This is looking at price on the 2 higher time frames, and this is looking at momentum and the order flow and the market delta moving average of your 2 higher time frames. That makes it an independent variable. It doesn't depend on the movement of price on your trading chart to change color. The movement of price on your trading chart has no effect on this indicator. Now, if you want a counter trend trade, you have to wait until order flow and momentum have changed color and have aligned to the downside. Here's the same trade. This is a monster trade on the E-mini with order flow and momentum aligned to the downside. Now, if you've ever asked yourself, why does the market chop? I can show you right here one of the reasons why. When these independent forces don't align, price really doesn't have a direction. So when momentum is saying short and order flow is saying long, price chops. And if you try to take a trade during this period of time, there's a high likelihood you're going to get stopped out. You have to wait for their alignment and then trade in their direction. And you're also going to get to run over all the traders in the counter trend direction, trading all of that failed analysis that's been bankrupting day traders for 20 to 25 years. This is why 95% of day traders fail. They're looking at an analysis that is telling them to counter trend trade during a period of time when there's no way a counter trend trade is going to be successful. Here's another example. Alignment, break a resistance, a long trade, break a support, long trade right up to resistance. And one more example, when there's no alignment, there's chop. Alignment, break, up to resistance. You know the direction you must trade. And here's an example, just using order flow. You break support, order flows aligned to the downside, price is going to fall. Remember, there's selling pressure in the market right at this time. Price is almost always going to fall because the selling pressure is manifested in 2 higher time frames, and you're going to get a nice short trade right to support. You can trade long off support when order flow rotates, and you can go long. And then you can trade off resistance to the short side when order flow reverses. And you have to wait at support until order flow reverses again. This is why this week in our live trading room, I only have one loss trading, because I always trade in the direction of order flow and momentum. Just another example, just using order flow. Sit on support. Only thing you can do is take a long trade and up you go. Now, I just wanted to give you examples where you have to wait. Here's your long trade off support, 7 ticks. Comes back to support, long trade 9 ticks. Back to support, long trade 31 ticks. You have a potential short here off resistance, but order flow hasn't turned. You have to wait. Here is where order flow turns, and there's your short trade for 33 ticks right to support. Your next anticipated trade will be a move up to resistance and a short if order flow is turned to the downside. Just another example, break, trading long in the direction of order flow. Now here's adding order flow, momentum, and the commitment of traders. COT's at the bottom, you're trading right off support, a beautiful long trade. Come back to support of the point of control, or to the left, order flow and momentum have aligned, point of control or this commitment of traders is at the bottom of the candle body, a great long trade. This is telling you, this is giving you an incredible insight into the sentiment of traders. It's telling you where there's an overabundance of buyers, an overabundance of sellers, where they exist in the candle body, everything that you need to know in order to increase your trading precision. If you want to trade where 75 or 80% of your trading entries are winners, you have to use these variables, these markers, or you're going to wind up taking losers. Here's a short trade. Order flow and momentum assessed on a multi-time frame basis on your 2 higher time frames. Commitment of traders is at the top of the candle, right at the level of resistance, and you get a great short trade. This is a very low risk entry and potentially a very high reward trade. Same thing. Now, this is also a signal that we put in. This fires intra-candle, it's orange, and it tells you that there's a massive overabundance of sellers present, and that the likelihood of a trend continuation down is exceedingly high. I mean, we're giving you everything that you need to know about volume, and volume in this manner, configured this way, is telling you what traders are thinking, what they're going to do out into the future. This is not a lagging indicator, it's a leading indicator, because this analysis is done on your 2 higher time frames, and this is a multi-time frame analysis based on volume profile. This has future predictive value. It's not just tracking an oscillator or a MACD on your trading chart. None of our software just analyzes price from your trading chart, because it doesn't provide you with any future predictive power. There's your counter trend, order flow and momentum, red, just to the right. You don't get a huge trade, but again, this is 13 range. You're going to get maybe 15 to 20 ticks, and that's not half bad. There's your long trade. Same thing, always in the direction of order flow and momentum. But you'll see in these 2 red candles, they're counter trend trading the direction of momentum. They're not going very far. So let's do a look back. I've actually moved through this faster than I thought. Usually I run way over. I still have some time here. We look at market profile, volume profile, the value area high, value area low, point of control, low volume nodes, zones of rejection, the delta moving average, the volume ladder, Heikin-Ashi momentum. I mean, it's a lot of data that's projected in a very easy form onto your trading chart. It's an actual trading system that you can use as a standalone. If you have a trading methodology already, it can be used to augment it, and it will significantly increase your win percentage. Because maybe you weren't aware of the commitment of traders inside each candle. Maybe you weren't aware of the direction of order flow on your 2 higher time frames, or the direction of Heikin-Ashi momentum. And some of your losers were taken because that particular force was not aligned in your direction on the trade. So it gives you a better window into what's going on when you're taking an entry. And as a day trader, the one thing, or a swing trader, the one thing that you need to be allergic to is risk. Day trading is never about the number of winners you take. It's always about the number of losers. And the reason we've made so much money this week is because I've only taken one loser. I don't have to take an enormous number of winners to roll up a really nice amount of money. So that's the most important thing, to trade with specificity and be able to look inside the market and see exactly what buyers and sellers are thinking. Now let me go over our offer. Now everybody gets the indicator, if they like it, at $7.98. And the offer expires on Friday. If you're one of the first 5 offers, what we do is we add this on. You're going to get 3 months in the live training room with me. So, and we use Chart Trader. I call out the trades in advance. I give you the entries. We have all the targets and stops projected. It's a very transparent trading room because our profit loss is projected on every trade. And I give you the entry way before it matures. So you're going to get a really good idea of how to trade the system. We also are going to put you in our educational training. And I think that's one of the pivotal things. You get 10, it's supposed to be an hour a session, but I have a lot of people in the training modules where next week is module 6, but then you'll come back around and you'll get modules 1, 2, 3, 4, and 5. And you're going to get them all on a link anyway, and you can view the first 5. But I'm going to teach you how to day trade and swing trade from the ground up. I mean, I'm going to teach you what to discard, about oscillators, about MACDs, about Fibonacci, about Elliott wave, about a lot of things that you've been told. And this is the type of analysis that really has been bankrupting traders for 2 decades. Now, the order flow tracking and momentum system is a separate indicator, but we're throwing that in. So you learn everything from the ground up. You're going to learn what to avoid, when to avoid a trade, and when to take a trade. And you're going to really be able to hone down your entries and only take them when you have the highest probability of getting a winner, and that winner has the highest probability of becoming a runner. So that's really what this whole system is all about. So let me see if there are any questions. You know what, Priscilla? It does not yet. It works on Sierra and it works on Ninja. It doesn't work on MT4. You can download a dummy or a demo of Ninja and still trade off of MT4 and make sure that you're aligned with the indicator on the Ninja platform. You can also get a free Sierra charts version as well. So we don't have it on that version yet, I'm sorry. but those are the only two platforms we've got. No problem. Any other questions? Yes. Listen, it works on any time frame, on any market. You can trade 5 range, a 2 hour, a 4 hour. You can trade any tick. We use it on stocks. We use it on Forex. I trade futures. And what we're going to do starting in 2018 is we're going to be creating a hybrid trading room. We're going to trade stocks and we're going to be trading futures. So it's the only trading room that's going to do it. We're going to trade both at the same time. Okay. Charles, the trading room is open in the morning. We start at about 20 minutes after 9, right before the opening of the NYSE. And this morning we traded till about 11 because I have a rule. We get 3 winners and we close, and we just got bang, bang, bang. We got 3 winners. So we either hit our profit target and close. Our profit target is between $400 and $500, or we trade until about 12:30, and it starts at about 20 after 9 Eastern Standard Time. Yeah, it's Eastern Standard, Priscilla. Yeah, yes. Well, you know what, Ness? They're 2 separate versions, but if you're really, really interested, we'll give you both. It's not a problem. I mean, we'll give you the Ninja Trader version and we'll give you the Sierra Charts version. That's not a problem. If you really want them for both platforms. And remember, the first 5 are going to be in my room for 3 months. And we charge $149 a month, and we have 125 traders in the room. I was going to post it, but then I decided not to. We had a whole bunch of people post their back end of their results today. I can't show it now. One guy made $800. He posted it and he emailed it to me. One guy made $650. We made between $400 and $500 in the room. We made about $455. I just trade very, very methodically, very conservatively, and my mantra is I don't want to take any risk. That's all I do. So listen, that's really it. I mean, I welcome you into the room. I do not think, and let me just say one more thing. I'm not like a lot of people who proffer you software and then don't trade it. We trade it live in the room, and I stand behind it because I make money with it, and I make money with it almost every day. If I told you I made money with it every day, I wouldn't be telling you the truth. Because sometimes you'll get taken out of a trade by, I call it getting wicked out. Once in a while, a wick will take you out of a trade. And you could take 2 perfect trades and a wick will shoot up and blow you out of the trade. But it doesn't happen very often. So you're not going to make money every day. But if you make money 8 out of 10 days, and the amount of money you make dwarfs the amount of money you lose, then you're going to make a really, really nice amount. We have traders in the room trading 20 lot on the E-mini, and they're trading 8 contracts on crude. And what I trade right now in the live trading room is I trade crude, I trade the E-mini, and I trade the 6E. Now we're going to be adding a stock right after the first of the year. Today I was watching Netflix, and I'm not sure what stock we're going to be putting in. What I'm going to try to do is trade a $10 to $20 stock, so you can trade it with a small account. And I get 2 data feeds, Options Monster and Benzinga Pro. And in those, in the morning, I check the data feeds and look at, what has the upgrades, the downgrades, what has the big news crossing, what's really going to create major volatility in a stock that that's not exceedingly expensive. And those are the stocks that we're going to look to trade every morning. Ness, we'll put Rory, can you put the purchase link in? Ness, it's in. If you don't see it, Jeffrey, you have to have a data feed to run your chart. So obviously you do. There's the purchase link. Well, listen, if you're trading, Jeff, you have to have a data feed already, correct? You just don't need an additional data feed. If you're trading stocks, this will run off your stock data feed. If you're trading Forex, it'll run off your Forex data feed, whatever you're using now. And we use a CQG data feed for futures, and I use a kinetic data feed for stocks. And Ninja allows you to hook them both up at the same time. And Interactive Brokers allows you to do that. There's only a couple of brokers that allows you to do both at the same time. So we can trade stocks and we can trade futures, but you do need a live feed for sure. You must have that. So listen, that's it. I'm right there at 2:26. I'm 4 minutes short. I welcome you all in, and again, I'm going to teach you how to trade from the ground up. And I'm just going to tell you this because I have 2 minutes. I'm going to show you the math in the educational training. I'm going to show you the mathematics of trading. And I don't think it's something that you've ever been exposed to. If you want to understand how to day trade, you have to understand the definition of sensitivity, specificity, positive predictive value, negative predictive value, and prevalence. Because if you put those all together, they provide you with a trading methodology that is exceedingly sound, where you want to trade with a real high order of specificity during a time in the market, which is defined as prevalence, when the prevalence of getting a winning trade is high. And that module is the biggest eye-opening module that I do, because you never hear anyone who offers you software talk to you about what's the sensitivity, specificity, and positive predictive value of a trading entry, because they don't know it. And if you don't know this, then the value of the entry is zero. You have to know the kind of precision it offers you when you trade. So it's really all about math. We don't look upon day trading and swing trading as an art. We look upon it as a science. So everything is defined scientifically, including your entries. And that's what you're going to learn in the educational training. And this system really, really helps us inordinately get winning trades. So listen, everyone, have a really, really great afternoon. Thank you so much for your time. I really appreciate it. No matter what you do, I really wish you guys the best of luck. We're the small commercial trader. We have to take money from the other small commercial trader. We are never going to beat the large institutions. What we have to do is trade with them. And this is what the system allows us to do. We know when there's more buyers than sellers. And when there's an overabundance of buyers on 2 time frames, it's the institution stepping in. When everything aligns on this system, it's because there's money coming into the system from the institutions. We can't beat them. We got to trade with them. And we got to run over the other small trader who's counter trend trading in the direction of money flow. And that's exactly what this is tracking. Order flow tracking is a system to track money flow. So listen, everyone, have a great afternoon, and I look forward to seeing you. And best of luck. Bye-bye all.